Hello everyone, welcome back to my channel. So this video was an idea that I just came up as the markets developed in a way up and all the way until last Friday, and we are recording this, as you can see here, on Sunday, February the 16th. And the way markets developed all the way until last Friday, especially when it comes to the price of the QQQ, the ETF that tracks the Nasdaq index, as you can see here, the way it developed, it provided a very good example that shows why some new traders that are looking to initiate or start their journey in trading, why many of those fail to reach profitability with their strategies. And so as many of you probably imagine, when you are looking for a stock or an index fund or whatever, and you believe that, or an ETF, and you believe that the price is going up, the first impulse that you usually have, or the first trade that you can think of, is to buy options, especially a call option. But in this video, what I'm going to show you that this may not be the best strategy, and most of the times it is not, and in the long run it will cause you to lose money, and instead it is much more profitable for you to sell options instead, because of the reasons that I'm going to show you. And it's much more profitable given the probability of the different outcomes, and given also the probability of the way the markets are going to behave while the options are live and all the way up until their maturity. And so I'm going to show you this real life example, and of course, for any questions that you may have, feel free to leave your questions in the comment section below, or you can also DM me on LinkedIn for any specific points that you want to raise. And so moving on with this example, and I'm going to show the trade that I did last Friday, and I'm going to, of course, use an imaginary person. I'm going to give him the name John Doe, who is going to be my counterparty for the sake of this video. And so, as many of you notice, if you've been following my challenge, the Road to 100k realized return challenge, at the beginning of the day on Friday, I held 300 shares of QQQ, and on February the 14th, and I put here a small print or a screenshot of the trade that I did. I sold three call contracts, 0 DT, so these are calls which would expire on the same day, February the 14th, so it's 0 DT call options, and with a strike price of 537. And I held these shares, I sold these three calls. Let's just assume that our counterparty, John Doe here, bought our three calls from me, and as you can see here, I received from John $1.16 premium per share, and this equals the grand total, because there were 300 shares, of $348. All right, and this is the total amount of premium that I received. I also paid $1.38 in fees, and on the other hand, of course, obviously, John paid me $348 in premium, and let's just assume, for the simplicity of this exercise, that he paid zero fees, which I believe chances are he did not. He also paid fees as well, but let's just assume that he did. He had a waive in fees. And so basically, by setting up this trade, this is the various scenarios of our outcomes. And so from my perspective, I sold a call option, and so I'm already up in terms of my position of the trade. My trade is already profitable once is already in the profit as soon as I filled in the offer or the trade. And so As you can see here, the strike price is 537, and the point at which I will break even is if the stock goes all the way up to $538.16. So as you can see here, I win the trade as long as the share price stays below this precise break-even point, $538.16. And why is that? Because any price below that, and let's just assume it stays below 537, option expire worthless. I keep the share, I keep the premium, no other flows take place, the option goes away, is not worth anything, so I keep the premium for myself. And if it ends up between 537 and 538.16, all right, I still have a small loss, but this small loss is more than compensated by the premium that I received at the beginning of the trade, so I'm still in a profit. However, if the price goes 539, 540, I lose, because even though I received 537, it would have been better for me not to sell the call option and at the end of the day just sell the shares in the open market at 539, 540, whatever the price may be. And so as you can see, my trade, or my end of the trade, from my end of the trade, the premium of $1.16 provides a cushion against any potential losses in case the share price rises. So the premium provides me an additional leeway in terms of the price moves that allow me still to stay in the profit. However, from our friend John Doe here, he only wins the trade because, as you can see, the long position is exactly the opposite. It's the mirror image of mine. So he's already with his position begins with a small loss. He's in the loss because he already paid a premium, and so he only wins the trade if the stock price goes above $538.16. And why is that? Because he has to pay, if he wants to buy the shares, he must pay 537, and he already paid at the beginning of the trade $1.16, and so the price must go all the way up to 538.50, 539, 540, so that he can buy the shares at 537 and still keeps a profit, because the option, the stock is valued higher to an extent that it's higher than the 537 and completely offsets the premium that he paid to begin with. And so that's why the spectrum of outcomes that allow John to win the trade are much smaller here, and considering that we begin the trade with a price of $536.08, as you can see here, because if you see here the candle for the February 14th, the opening price, and I'm going to show this in a slide as well, is 536.08, and so in this situation the current price is somewhere around here, and so all the moves that goes around this price are favorable to me and unfavorable to John, and only this particular set of outcomes, which is above 538.16, only these outcomes are favorable to John's position. And so that is why we have a much bigger probability of staying within the range in which we win than the stock price going to the range of outcomes that allow John to win the trade. And so as you can see here, I also provide, it's the same picture, as you can see here, exactly the same. So the prices to begin with were 536.08, the date is February the 14th, and so as you can see here, this picture was taken during the weekend, and so the price ended up at the end of the day at 538.11. And so assuming this price will stay the same by the time the markets open at the beginning of the next trading day, and so the stocks can be cashed in by John in the open market at 538.11, and assuming no commissions as well, you will see that at this point, and with this, and of course assuming that of course the call was exercised, because he has the option, not the obligation. So at 538.11 he will exercise the call because it makes sense to do so. It's the correct decision. I sold the 300 shares at 537 each. He bought those from me, and so as you can see here, I receive 537, but the stock price currently is 538.11, but I still have kept the $1.16 from the premium that John paid me to begin with. And so I ended up with a 5-cent profit, which of course multiplied by the 300 shares, it gives me this profit of $13.62 on this trade. Of course, John is in the mirror position. He's my counterparty, and so he has the loss of 5 cents. And of course, we don't know how many fees he paid, but we assume that he didn't pay any fees, and so he had a loss of $15. So as you can see, and this is a very, very, very important point to make, and that I did not put this in here, but I'm going to add it. I'm going to add this in here because this is a very important point to make. So let's put it like this. So even though John got his prediction right, because he predicted, otherwise he would not have bought the calls, so that if, the stock would rise in price. The stock, and this is the critical factor, the stock did not rise enough for him to make a profit. And so this is the key why buying calls is much more of a losing trade than a winning trade in comparison to selling options. Because when you buy calls, and let's just put it here, because let's put it like this, because when we buy calls, we need to predict the direction of the trade, of the direction of the price move. All right, so if it's a call, it goes up. If it goes or if it goes down, we buy a put. All right, and we need, or should I put like this, as well as by how much the price will move. All right, and so when we sell, let's just see it in this case, of course, when we sell puts, because we are assuming that the price will go up, so the correct decision is to sell puts. So when we sell puts, we only need to predict that the price will either go up or stay almost unchanged. All right, because we win either way. We only lose if the stock goes down by a certain extent, and this extent can be controlled by picking the strike price. Of course, you can also choose. You can also pick the strike price of when we buy the options, but the set of outcomes that allow you to win when you buy calls is much narrower than if you sell puts, and so this is the main reason, and this is reflected here, as you can see. And I also took this transcript, these screenshots also from here, because if we pull up the options chain on QQQ, you will see that, for example, if we sell a put here, we have a probability of profit of around 84%. Of course, market data from from Friday at the end of the session, so this is not live data. But as you can see, and this is showing right here, that if we sell a put, all right, we have a probability of profit of 84% because we win whether the stock goes up or stays at around the same price. In this case, even if the stock goes down from 538 to 537, 536, 535 and a half, we still win. We still keep our profit, all right? And even, for example, because we receive 8 cents in 80 cents in premium, our break even is 534.50. So we 0.20. So if it goes down to 534.50, we still win. We still keep. We still profit. However, as you can see here, if we buy a call with a strike price of 540, we can only break even if the stock goes up. And recall that the stock price currently is 538.11, as you can see here. As you can see, the price needs to go up by almost by more than $3 so that we can profit. And that is why, and any other outcome makes us lose, because if it stays below the 540, it makes no sense to exercise the call, and you lose the premium. You only win if the stock goes up 541.21 cents. And so that's why you have a much smaller probability of profit, which is reflected right here. And so that's why profitability of profits of selling puts is higher than the probability of profit of buying calls. And the same goes if you believe that the stock goes down, or if you want to monetize the shares that you already have, as was in the case that I showed over the course of this video. So if you sell a call, you see, you have a probability of profit of 69%. And as you can see here, I'm going to take this trade out. If I sell a call here, as long as the stock price stays below 540, we win the trade. And if it goes, for example, all the way to 541, we still win, because we receive 1.19 in premium, and so the break-even is 541.19. So if it goes all the way until 541, we still win. Only if it goes above this, we lose. But on the other hand, if we buy a put, and this is the trade that I also show right here, as you can see here, with a probability of profit of only 16%, you can only win if the stock goes below 534.19. So if it goes down to 534 exactly, or 533, 532, only then you will win. Otherwise, if it doesn't reach the 535, you lose, because the put expired worthless, so it makes no sense to exercise. And even if it reaches 535, you still lose, because you still have to offset the premium that you paid, and so you only offset the premium if it goes below 534.19. And so that's why the probability of profit is higher for selling calls instead of rather than for buying puts. Now, with this in mind, we need to ask this question: if it's selling options is always better than buying options? And the answer is a resounding no. Absolutely not. There are occasions in which buying options are better than selling options, and this is something that I already talked about in some of my previous videos, in which, as you can see here, buying options is a bet on high volatility, and I forgot to add here, selling options is a bet on low volatility, right? Let's push this a little bit up here. And so why is that? Because here, and I put here the graph of the VIX. For those who don't know, the VIX is the index that tracks the fear of the market, all right? And so it measures the volatility of the market, because usually when markets have very high volatility is when there is very high fear or panic in the market. And so, as you can see here, there are very, very few periods of high volatility in the market. For example, here around the end of 2008, 2009, with the great financial crisis ongoing at that point, there is a very, very high degree of panic in the market. There are a few spikes here. For example, when Greece defaulted had his first default on his debt, and other European economies had his sovereign debt also under attack and under the speculation that they would probably default. Here again, around 2012, the end of 2011, beginning of 2012, the same thing with other economies, but then a period of pretty low volatility ensued, with a few spikes here and there, until around March 2020, when the COVID pandemic hit. Still with a few periods of high volatility here, with the following waves of the pandemic ensued, and then here another few periods of heightened volatility because of the conflict between Russia and Ukraine. But then after that, a period of low volatility also ensued. And so, as you can see, the market is most of the time under low volatility. And so, as you can see, during periods of unexpected high volatility, for example, the great financial crisis and the COVID pandemic, buying puts, for example, is usually profitable, because it protects against large declines in share prices. When the panic is everywhere in the market, buying puts is usually profitable. They are more expensive, of course, but they are still profitable because they protect against large declines in share prices, and so your downside risk is pretty much hedged away. And so it is a profitable or an advisable trade to make. On the other hand, during periods of high expected volatility, for example, when companies release their earnings, when central banks announce their interest rate decisions, buying puts and calls protect, by buying puts, protect, as I mentioned, against large losses, right? And by buying calls, you still capture gains by having large upside gains. For example, if a company release its earnings and earns vastly expected, vastly exceed the market expectations, and their earnings guidance still says there is a lot more to come, and so it's likely that the stock will skyrocket, and so by having by buying a call option, you will capitalize on those gains. The same thing as in terms of interest rates. If the market expects a given central bank to hold interest rates steady as they are, and the central bank decides to surprise the market with an interest rate cut, for sure it is likely that the market will react very positively and prices will go up significantly, and by buying calls you will be able to capitalize on those upswings. But as I mentioned, and as you can see here in the graph, this graph spans a period of probably a little bit more than 20 years at this point, from 04, 05 until all the way until where we are today at the beginning of 2025. High volatility periods are rare, and for the most part you will profit by selling options because low volatility is usually the norm in most times, and so on those times it pays to sell options rather than buy, because the set of outcomes that allow the option seller to profit are much wider, and there are many more outcomes that favor the option seller than the option buyer. And so basically this is what I wanted to show you today. As I mentioned, any questions that you may have, feel free to drop me a comment or a question in the comment section below, and also you can DM me on LinkedIn, and also feel free to like the video and subscribe to the channel. And I will come back with another videos, and of course in the meantime feel free to also follow the challenge, which will enter a very interesting phase, because now we got rid of our shares of QQQ, so it's time to sell some puts to earn more premiums. And yeah, I'll see you there.